Hello, this is John Pugliano from Investable Wealth and the Wealth Studying Podcast. Hey, just want to give you a quick economic update. Normally, I like to give economic updates when I'm on a road trip. This time it's a little different. My wife is actually headed on a road trip, and I took her car in to get the tires rotated today before her trip. And something hit me about the economy. Actually, didn't hit me about the economy, but it was, I thought, a good analogy to show what is going on in the economy. When I went into the tire place this morning, there was literally no one there. I was the only one. I was in and out in less than 15 minutes to get my tires rotated. Now, while that wasn't a record prior to the pandemic, certainly in the last 3 years, anytime I've gone in for any type of automotive service and even just, getting my tires rotated or buying new tires over the last 3 years, it's been a major challenge. I mean, there's literally been times during the pandemic when there was a line of people standing up before the tire shop even opened. They're all outside, social distancing, wearing their masks, waiting in line just to buy tires at extremely elevated and extortionary prices. The reason for that was just the supply chain issues. The economy, had been a wreck. Now, years into the pandemic, it seems like things are much better, and they are, but we still haven't recovered totally from that wreck. And that's why we're seeing the strange fluctuations in the market. I mean, you looked 3 months ago, people were literally in sheer panic that the banks were going to collapse. And now here we are 3 months later, and people are irrationally exuberant that artificial intelligence is somehow going to save the economy or save the stock market. Listen, I didn't buy the bank panic 3 months ago. I don't buy the artificial intelligence hype now. And it's not that I'm anti-technology. You can check out my book, The Robots Are Coming, that I wrote all about these trends, going back. I wrote that book in 2016. So in any case, back to today's economy. Seeing the lack of people in that tire shop, not only the lack of people, but literally no one there but me, is very characteristic of what's going on in the economy right now. We have the services sector, which is doing extremely well. That's what's holding up the economy. But if you look on the other side of things, especially from like the Purchasing Managers Index or any of the leading economic indicators, you'll see that on the manufacturing side, not only in the U.S., but pretty much across the globe, manufacturing output is down, inventories are up, new orders, backlogs, things like that have totally dried up. So we're seeing what some people are calling a rolling recession. Other people are calling it an earnings recession. I'm looking at this as just a lopsided economy, an economy that's not firing on all cylinders, if you want to draw a car analogy, an economy that is out of phase with itself. And I guess another car analogy to deal with tires would be, a car that's out of alignment. You need to take your car in to get it realigned. And that's what we're seeing in the economy. The economy is still out of line. And this has to do with a number of reasons, trends that were in place before the pandemic, as well as those that have been exacerbated by the pandemic. And we need the recession to realign the economy. A lot of people, especially the gloom and doom industry, they want to show a recession as being a horrible thing for the economy and an economic collapse. And that's never the way I look at recessions. I look at them as needed check valves in the economy. They're great times to invest as long as you're investing during the recession and that you don't get in, ahead of the blow off top. And I think it's very likely that we're still in that situation, and we need a recession to, realign the overall economy, to bring all the factors of inflation back into control, to rein in not only the excesses we've had in fiscal policy, but also in monetary policy. And we're simply not there yet. There's still more than $2 trillion floating around in the system, more than what should be there otherwise. Now, with all that, you can say, well, where's the recession? And I agree. And actually, if you look at this channel, going back through the whole history of it, I have consistently argued that there isn't a recession. Again, go back, scroll through the old videos, and you'll see things about where's the recession, or is there a pending recession? And my argument has always been there isn't one. I didn't change my tune on that until towards the end of last year, fourth quarter of 2022. And again, number of reasons for that, but one reason predominantly was that it appeared for the first time in really 20 years that the Federal Reserve was serious about raising interest rates. That hadn't happened up till that point, and now I do believe that they are serious about holding interest rates higher for longer. As a side note, the whole geopolitical instability also has very much concerned me since the Nord Stream pipeline got blown up last, I believe it was September 26th. In any case, you put all that stuff together, I have been preparing for a recession. I am 90% in money market funds that are paying, around 5% interest. I think that's a good place to be in terms of your risk reward factors. But again, you can say, well, where is the recession? Again, 3 months ago, 4 months ago, people were panicked about a banking collapse, which was nonsense. Now they're all hyped up, and the market's up to 4,400 in the S&P 500, simply based on a relief rally over all the enthusiasm about automation, and you have a good, 8 to a dozen stocks that are really driving a lot of that rally. So where is this all taking us, though? Where is that recession? Why hasn't it happened yet? Again, a number of factors. A lot of it has to do, though, with that still more than $2 trillion excess that's in the economy, and you couple that with the earnings power that employees have, which has been primarily accelerated because senior citizens, older people retired early because of the pandemic. That took millions of people out of the workforce faster than what was anticipated. That's creating a lot of the wage spiral that isn't done yet, and it's not just U.S. or North American phenomena. It's happening all over, especially in Europe. And you factor that in, I guess, with the geopolitical issues, and what you end up with is an economy that's on the brink. And if the Federal Reserve keeps rates even at this level, even if they don't raise another 1 or 2 times like people are expecting, if they just keep them at this restrictive level with all the refinancing that needs to take place and the drying up of loans and then the illiquidity because the Treasury has to issue more short-term Treasury notes to fill their coffers. When you add all those things up, it is totally slowing down the economy, and it will give us that recession we need to reset the overall money supply factor. That's the biggest part of it. But here's the catch. The Federal Reserve is supposed to not be political. You can choose to believe that if you want. I don't believe it. I also don't think that they support any political party. I think it's actually the other way around. Again, we can argue that point. I put out a blog post, though, I think it was last week. You can check it out over at investablewealth.com. It was titled something about interest rates and elections. And if you look at that chart, I showed that over the last 72 years, there have been 11 recessions. 4 of those have occurred during the re-election year. And in 100% of those 4 incidents, the party that held the White House at the time that there was an election and we were in a recession, that incumbent party lost the election. Whether it was a re-election or an election for a new presidency, whether it was a Republican or Democrat in office, they lost. Incidentally, 3 of those 4 times it was a Republican administration that lost. So if you look at a chart of any recession, you can see that this imbalance that we have in the economy, that is always corrected by raising interest rates, which is what the Federal Reserve is doing. And so you can make the argument, either directly or indirectly, that recessions are caused by the Federal Reserve raising interest rates. And the question is, does the Federal Reserve want to cause a recession into 2024 in a presidential election year when the Democrats are holding the White House? Now, given the fact that the immediate former chair of the Federal Reserve is now in the Democratic administration's Treasury, that's Treasury Secretary Janet Yellen, and given the fact that up to a couple months ago, the vice chair of the Federal Reserve, again, she was serving as vice chair, this is Lau Brainerd, she has now been appointed to lead up President Biden's Economic Council. So, again, you can decide for yourself which side the Federal Reserve may be on, or looking at it from a more even cynical standpoint, which party is more aligned with the Federal Reserve in terms of not the parties controlling the Federal Reserve, but the Federal Reserve controlling the parties. In either case, I think there's a strong argument to make that the establishment, whether it be red or blue, it doesn't really matter, but the establishment is aligned with the Federal Reserve, and they have to do that because they know the fate of the economy is primarily driven by interest rates. And again, you get to that standpoint of, does the Federal Reserve want to see the Democrats lose the White House in 2024? I don't think they do. Again, I'm willing to hear your comments, and the point can be argued. But if they don't want the administration that's currently in the White House to lose in 2024, then they need to get that recession going now. And I would have thought it would have started in March or April of this year, because we can't go into 2024 with a recession if the Biden administration is to win re-election. So that means that we have to get this recession going between now or very shortly hereafter, so that it's over by the end of first quarter in 2024. It's got to be over by March of 2024 to have the voting public, who has a very short memory, they'll forget about the recession and interest rates will get lowered. The economy will start to recover. Unemployment will start to pick up. Unemployment will stop going down. Employment will pick up again. Everything will be rosy. The government academics, the government economists, and the academic economists, and the news media, and everybody in the administration, all these forms, again, of the establishment will come out and tell you how we've recovered, how phenomenal the economy is, and why you should vote for the current regime. That is not just my creativity coming up with that scenario. That's what's happened time and time again as you look through election cycles and you see the seasonality of how the stock market performs every 4 years during a presidential re-election campaign. So my argument here is that, yes, the economy is out of line. Yes, we need a recession to correct it. If we don't get it quick, though, we're not going to see that recession, I don't think, until after the November elections, which would put us into December of 2024. So in the next few weeks to couple months, we could still get a recession, which I believe would give a major correction in the stock market, especially considering where we are at these very lofty valuations. And then on the other hand, if we don't get this recession, as we get into the end of third quarter this year, beginning of fourth quarter this year, then we're probably not going to see it until sometime after December of 2024. So, hey, am I right or wrong? I can't predict the future. These are just my thoughts. For now, I'm remaining 90% in cash through money market funds. And as the economy evolves and we see what happens with interest rates, you'll see how I move back into this market, whether there is or isn't a recession, because the bottom line coming out of what will eventually be a recession is going to be a very strong economy in North America, even if it's only in a handful of sectors. But I see bright things ahead, and come on back and we'll see what happens.